you are in the country. We're going to get started now talking about first in Equilar's webinar series talking about pay for performance that we'll be doing over the course of the next 2 months. This webinar will be focused on kind of simulating the ISS pay for performance test, really looking at that quantitative side of the analysis that ISS is doing. Before we get started, I'll actually note, I know that last time there was a few people who weren't able to view the slides, but were able to listen in. If you are unable to view the slides through GoToMeeting for any reason, but you've currently been dialed in, you can actually download the slides right now on equilar.com/slides.pdf. That'll give you a full copy of the slides so that you can follow along in the presentation. You can also, if you send through the chat, if you send a question to our administrator, they'll also be able to give you that link. For anyone also on the webinar who's interested in the slides, we'll also be sending the slides out after the webinar, and we'll be taking some questions as we go. So I guess the place I want to start off with the ISS pay for performance test is actually with kind of a philosophical point that I think has potentially been lost along the way. And what it really comes down to is that simulating the ISS pay for performance test doesn't require an advanced mathematics degree. It doesn't require much more than running some percentiles, percent ranks, and being able to do some sums. What it really requires is a set of data, and that data can be somewhat hard to come by, but the tests themselves are fairly straightforward. And we're going to kind of walk through today how exactly you might want to try to replicate what they're doing so that you can simulate the scores that ISS may be giving you. I'll note as a quick disclaimer, obviously ISS is a registered trademark of MSCI. We're not affiliated with them in any way. So all of the information that we're going to be presenting here is really based off publicly released information and disclosures from ISS. So things may change throughout this presentation, but it's going to be based on a lot of the information that ISS has already released. So just real quickly, what we're going to walk through, we'll look at the peer group creation methodology, how they measure compensation, as well as the 3 main tests that ISS will be performing that make up the quantitative factors that ISS is looking at. So peer group creation, and I think based on some of the supplemental filings that companies did last year, I think peer group is probably one of those places where there's probably the most unknown and the most disagreement with what is currently going on. But that said, there's really only a small bit of information that you need. So you need to know what your GICS code is. Obviously, GICS is vitally important for the ISS peer group creation. You also need a list of every company in your 2-digit GICS. So GICS code is a number that builds off itself. The first 2 digits represent a very wide industry, and you need basically 2, 4, and 6-digit codes for those companies. ISS has also stated that they'll be running their peer group systems only twice a year. So once is basically the biggest one is in December, and all the information will be based off of the trailing 12 months revenue information prior to December 1st, as well as the most recently disclosed assets for any financial firms prior to December 1st. And then they're looking at market cap on December 1st. And using that information will actually be the only things you need to be able to start simulating what peer group you might be looking at. Obviously, what's really nice about this is this information is available. It is out there that you could start acquiring. I think probably the most difficult piece here to get is GICS. But if you have it, you could certainly walk through this. So we're going to walk through a kind of example right now and walk you through the process. And this is not a step-by-step exact process. It's more of a general guideline here. But basically, take the list of your GICS codes and filter it based on matches for the 6-digit match, a 4-digit max, and a 2-digit match. From within that, look at all the companies that are between 0.45x and 2.1x of your revenue or assets, depending on if you're a financial organization, and then 0.2 and 5x of your market capitalization. And then the big key here is actually that 0.2 and 5x, which is an absolute limit. If you're going through the normal process and they don't have to select companies by hand, that's going to really be an absolute threshold and maximum for any company that you can be included by. Once you've got the list, start with that 6-digit, every company that matches in the 6-digit GICS, and start selecting larger companies and smaller companies based on the ones that are closest to you in revenue until you have up to 24. If you have somewhere between 14 and 24, you're done. That'll be basically, you just run the full simulation. If you have less than 14, you're going to repeat the selecting larger and smaller off the 4-digit list, and if you still don't have 14, off the 2-digit list until you get there. And one of the biggest steps is if you still can't match off of revenue, keep all of the companies you've previously included, but remove the revenue criteria and just use the market cap list and start back with the 6-digit list, the 4-digit list, and the 2-digit list until you get 14 companies. So to do a kind of a sample here, what I would have done is that if I was running for a specific company, I might have generated the list that you see here, and it's a list of companies or ticker as well as a GICS code. The trailing 12 months revenue as of December 1st, as well as their market cap on December 21st. So the first thing, easiest thing to do is you can just immediately eliminate any company outside that market cap range that I mentioned before. And you'll notice all of these companies match on the 2-digit GICS, so we'll be able to kind of stepwise pick companies. So once I've eliminated all of those, you'll see them marked in red and crossed out. What I'll first do is I'll first start by collecting companies that are within my revenue range and also match my 2-digit GICS code. So through this process, I've identified 3 matching companies. Obviously not enough for me to continue, so I'll go to the next step. And then I'll look for in that 4-digit range and then a 2-digit range. Now, it just happens that all of these companies have the same 4-digit range, so I kind of just skip that step and start looking at the same list. But I've identified another set of companies that will match. And then again, I drop that revenue criteria. So you'll notice that I'm getting a much wider range of revenues, basically going from about 60 billion in the last 12 months to about 6.5 billion in the last 12 months. And that's simply because we had to drop the revenue criteria to get to 14 companies. The other thing to note is that you'll only ever be compared with more than 14 companies if you have a high number of matches in that first step. So otherwise, you'll only ever be compared to with 14 companies. So as you're running your simulations, if you're trying to identify companies, looking for a number of companies around 14 will probably be the best bet. So as I noted, the process here is pretty simple to do this. And now selecting these peer groups by itself is unnecessary. What we're going to use is we're going to use these peer groups for subsequent tests. And as I mentioned, really the key piece of information here is GICS, and it's probably the one piece of information that is the hardest to acquire for most people. And one of the things that Equilage is currently working on, and we'll be coming out with in the next week or so, is including this and auto-building it off of this simulation, kind of in the same stepwise process that I mentioned, so that you can run this simulation as many times as you want. And additionally, after ISS updates their list of companies in June or July, you'll be able to run it again so that you'll get a sense for how that list might be changing. As I mentioned, that would be out in a week or so. So the next big question, so we've just established how I can pick my peer group. The next question that can come up is how I measure compensation. And ISS seems to have been pretty consistent with how they measure compensation. They looked at targets for a long while, and they're continuing to do so. So they're going to look at a total compensation as they measure this, which is composed of the base salary from the summary compensation table, discretionary bonus from the summary compensation table, total non-equity incentive plan payouts from the summary compensation table. And I'll note that that includes both long-term cash as well as any short-term cash payout. They'll be looking at the change in pension, non-qualified deferred comp earnings above market value, and other compensation. Now, all of those are going to be pretty straightforward. They exist solely within the summary compensation table, and with the exception of base salary, which in the past they have annualized as part of their methodology, and we would expect them to continue to do so. And what I mean by that is, if a CEO joins in the middle of the year, they'll annualize his base salary for the full year. All of that information will become directly out of the summary compensation table. The 2 points that can be slightly tricky, and again, kind of just gets into you have to have the data. It's not necessarily difficult to understand, is the restricted stock awards as well as the stock option awards. And again, and of the two, restricted stock is going to be definitely the most straightforward. So if you're looking at both time-vested shares or performance-based shares, you're going to calculate them based on the number of shares times the closing stock price on the date of grant. That'll be very likely very close to any of the accounting values that you reported. On the flip side, with stock option and other derivative equities, so that includes something like a SAR, the methodology more or less is unchanged from last year. And what I mean by that is the only assumption that they've actually changed appears to be the dividend yield. With instead of looking at the trailing 12-month dividends, they're looking at the average trailing 5 years of dividends. So this really probably won't change the methodology all that much for most companies. If you've recently dropped a dividend or recently increased a dividend, it'll kind of adjust that down or up, depending on the case may be. So it might not be reflective of exactly what's going on at your company. But the big point I will make here is that the assumptions that they give for volatility, term, dividend yield, as well as risk-free rate are definitely things you can back into. So volatility is a calculation you can do using your closing stock prices. The real challenge is going to be getting all of that data and valuing it for each grant. So each grant will potentially have a different dividend yield, could potentially have a different risk-free rate. And along the same lines, they're still sticking with that full-term calculation, which, if you look at historically, will be significantly higher than a potential reported accounting value from your plan-based award table. So, it kind of gets back to, again, here, sit down. Equilar wrote a report kind of summarizing a lot of the changes that's available to our clients in the Equilar Insight product suite and the Knowledge Center. I would look in there if you're trying to figure out what those assumptions are. But it's really going to be breaking that down and trying to get those for every single grant for all the CEOs in your peer group, which is going to be probably the only challenge. So, I kind of ran through it quickly, but it's, once you've identified the peer group that you're going to be compared to, which, as I said, isn't a real challenge once you've acquired the data necessary, and then the compensation, which, again, beyond really that stock option, is going to be pretty straightforward as well. Now it's time to do something with this information. So the first test is the relative degree of alignment test. And what you'll notice here is basically from here on out, the only things we're actually going to need is the peer group we created. I kind of walked you through how to create earlier. The pay values, which I'm also noted how you calculate, as well as the TSR score. And I'll touch on real quickly the TSR score here, and I'll talk about it a little bit more in the pay TSR alignment test. But basically the way ISS is looking at TSRs is that they're investing in the year previous to when they're starting the period, investing $100 into your stock, which could get you some fractional shares and some measure of fractional shares. And they're measuring how that value increases over time, depending on an increase in stock price and dividends that get paid out. And now this is going to be a slightly different calculation than just subtracting the difference in stock prices, especially if you pay out dividends, because as dividends get paid out, they are reinvesting them back into the shares of the company. And so if you have recurring dividends over the course of a year, you get a compound growth. So your TSR could potentially be higher or lower depending on the degree you're going. So you sit down and you calculate the 1 year and 3 year TSRs for each company in your peer group, the 1 year and 3 year pay values for each company in your peer group. You're basically going to take those and you just plug them into an equation. So you calculate the percentile for the selected peer group with 1 year and 3 year TSR, as well as 1 year and 3 year TBC. So you end up with 4 numbers at the end. I'll note just real quickly, the big thing to calculate here is a percentile instead of a percent rank. We've talked about in past percent ranks. As we were reviewing the documents, they kept referring to percentiles. We think it's going to be actually percentile, which will result in slightly different numbers, but the overall structure of how it would be calculated is the same. For each of the 1 year TSR and the 1 year pay, you multiply those percentiles by 0.4, which is a weighting that ISS has provided. And you multiply the 1 year TSR and the 3 year TSR by 0.6. Add the performance scores together, add the pay scores together, and then subtract from the performance score the pay score. And that's going to give you the end result of this test, which is some number between -100 and 100. And your goal here obviously would be a positive number, which would indicate that relative to your peers, your pay packages are smaller than the performance that your company is seeing. However, the real kind of thresholds are -30 as well as -50, which would indicate a levels of concerns that ISS might be applying to them. And as you can see here, because we're basing off the peer group, that peer group can be really important. However, because we're using a percentile, the really important thing is actually the rank, not the magnitude. So, as you're simulating this, even if you substitute one company in accidentally, it's really likely that it probably won't affect things overall, especially if you're looking at the thresholds that ISS is proposing. In addition, the relative degree of alignment test is going to be something, as I mentioned, it's not critically challenging. Basically, what's going to happen is, this is, again, as I mentioned before, something that we're going to be doing into helping companies simulate the peer groups. But we're also helping companies simulate actually each part of these quantitative tests. So what you can simply come in and do is you can actually run the relative degree of alignment test using your peer group. You can actually run it off of the ISS peer group. You can run it off any set of companies you want. You can see how you would stack up. We think this is a really powerful tool because it not only lets you predict what ISS would say, but also start looking at other, if ISS was to start looking at other peer groups or other methodologies, how would that play out? I got a couple questions that have come in. One question I think is real straightforward. Is there any discount for performance-based restricted stock units or performance-based anything? In the past, there have not been. ISS on the compensation side looks specifically at target values. So even if your board is used to setting target values that are not achieved, it's going to be measured off that target. In addition, as a kind of follow-up to that, if you have performance vesting rather than time-vested equity grants, the way that they're valued is actually identical. There is some qualitative factors that ISS does, which looks at the percentage of performance-based versus time-based equity and incentives. But the value and how they would value them and include them in compensation is kind of completely independent. And then lastly, and I think this is a very important question. So if you've got a performance stock unit or actually performance-based anything, are they going to look at the value that's reported in a plan-based award summary compensation table that represents the payout of those awards, or are they going to look at the plan-based awards table at the targets that were measured? And as I mentioned, they're really looking at the targets. So even if you're including information about payouts and essentially something doesn't get paid out at all, if it's in the form of equity, they're going to still continue to use that in the form of as a target. And it's actually one of those things where I think somewhat interesting, and as an aside, is that if you denominate it a long-term incentive in the form of cash, it'll get measured at payout level. Whereas if you denominate it in the form of equity, it'll get measured at target level. And even more detailed, if you're doing long-term cash incentives, it gets measured at payout in the year it was paid out. Whereas in equity awards, we measured at something when it is granted as a target. So there's a little bit of kind of disconnect between the methodologies there. And again, that kind of gets into what you can start doing with these types of tools, with the tool that we're offering, is you can start looking at how would my score start changing if I was using like a realizable pay number that would be looking at payouts as opposed to just including the targets, which, again, as I said, may or may not be earned. So now we'll jump kind of past relative degree of alignment test, and we'll look at the multiple and median test. And this test is probably actually the most straightforward of the tests. It requires very little information. You need previously created peer group. The one-year TDC values that we needed for the relative degree of alignment test, we'll use those again. Very straightforward. Calculate the median TDC for the peer group. Divide your TDC by the median, and that'll give you a multiple or a ratio. And what it would represent is what number of times greater is are you paying your CEO versus what peer group pays. And if you can think about this as relates to the relative degree of alignment test, what this is looking for is for companies at the high end who are performing at the high percentile or paying at high percentile won't be caught in the relative degree alignment. Whereas what this is going to be looking for is people who simply pay what ISS might define as an excessive amount relative to their peers. So by dividing these, you'll have some number. Obviously, there's potentially no upper or lower bounds on the number itself, but you'll find that the number should actually range in somewhere between 0 and 30. And ISS has stated that most companies are actually less than 3. And that's what some of the numbers they're looking at is around 2.1, 2.2, and 3 for companies that were going to be outside the norms in this range. So again, very straightforward test. If you're able to do the relative degree of alignment test, this one's going to be relatively straightforward for you. And again, I'll note, you can see below that this is something that we can help simulate, because while actually calculating a median off TDC and actually dividing your TDC by that number is not going to be a challenge. The challenge is just simply acquiring that data. And lastly, the pay TSR alignment test. And this test is going to be, we've learned the most about this relative to the other two. Those tests are going to be much more straightforward. You're just simply dividing two numbers or putting together a simple formula for it. But when I last talked about this in early December, I had mentioned we really didn't know how they were going to get a final score. So what they're looking for is they're trying to align how your TSR returns in a year with how compensation was paid out for that year. And I know already that there's been some criticisms about how those years are aligned because your pay decisions are made at the beginning of the year, whereas TSR goes throughout the year. But that's what ISS is going to be looking at. And we have a lot more information here, and I think this test actually might be the scariest in terms of formulas and math and how it comes out. But I'm going to walk you through it, and I think it'll be really straightforward for you. Again, subject you can get the data. So you need your yearly CEO TDC values for the last 5 years, as well as the yearly investment returns for the last 5 years. And TDC is going to be the CEO at the end of the fiscal year. So if you had transitions or a change in CEO at mid-year, they're going to be looking at that, just whoever was CEO at the end of the year. Investment return is going to be similar to what I had mentioned before, where you're going to take $100 in what they call actually year 0, and say, I invested $100, it's worth $100. How will that change between every point in time? So if you were to run this test right now, for example, off the 2010 data, you'd have 2010, 9, 8, 7, 6, and actually be measuring off of 5 where you invested $100. And you'll see the yearly change. I'll kind of walk you through it. But I'll start first with the really scary formula. And I remember looking at this, and what the formula is trying to do is measure the slope of a line in a weighted manner, weighting changes made recently, or growth made recently more valuable than growth or loss in the past. And when we looked at this formula, we're like, oh my gosh, this is really complicated. But it's actually really not. And I'll kind of step you through exactly how you would kind of look at this. So I would start with a simple table, kind of what I noted above. And you'll see X is the year, P is performance, and W is the weight. And if you notice, I've actually only highlighted 5 cells in a purple color. Those are actually the only cells in this table that you ever need to change. The 100 in 2005 is always going to be the same. I guess you could also change the years on the top. But the weightings are always going to be consistent, and the year is always going to be consistent. And what you can do, and I'll show a sample here, is I would hypothetically say that this is my stock price performance. You'll see I've changed the numbers to 109, 117. All you really are going to do is find W times X times, as one of the numbers, W times X times P, and you take the sum for every combination. So you'll see here you have a 0 times 100 times 0.661, 1 times 109 times 0.7837, et cetera, et cetera. That is the term that we saw right here. And that result, after you take the sum of all of those numbers at the end of the day, is what you're going to be plugging into this formula. And so there's a lot of math and a lot of formulas, equations you have to write out, but the math is all very simple. It's all from addition and multiplication. And once you've done that, you can actually determine what the slope of the line is for both performance as well as pay. And the pay weightings are going to be slightly different. You don't look at the 6th year. And then you can subtract the slopes. So the math, again, is not insanely tricky. It's not requiring any level of degree beyond statistics. It's very straightforward. But again, it gets back to that data. And I know it went through very quickly on how you create the peer group and how you measure the pay. But if you can get those two things done, you can run a very strong simulation on all the rest of it because all the math is really straightforward. Again, I'll note, the challenge here is not the math. The math is simple. It's very straightforward. I think what is the challenge is looking at how you're going to capture this data. And specifically, how do you capture it, not just for yourself, but for all of these 14 peers. The option valuation methodology can be somewhat tricky, not from understanding what the assumptions are, but actually getting the numbers themselves. So to help this and help our clients, we've been building, as I've mentioned previously, we've been building these simulations into our products. And so as an example here, you can see the 5-year CEO target pay versus TSR. And you'll notice you've got some numbers below, and then we've actually been providing slopes. And in this example, you'll see that TSR is actually growing twice as fast as pay is, which is obviously a great thing for this company. And it's really simple because you can come in and you can just simply do it. And this test doesn't require any peers. It really does allow you to model this out and really understand it on an ongoing basis with more discounting style. So, at a high level, as I mentioned, simulating this system is going to be tricky in acquiring data and making sure that you're matching those numbers because, again, those can be things that will dramatically impact the end result. If your option valuation is slightly off, or if you're included an award that they didn't include, that would be a challenge. But otherwise, it's going to be relatively straightforward in how you would calculate this. So I've got a couple questions. So the first one is, how would you find out a company's GICS code? So GICS code is a partnership, is developed by basically Standard & Poor's, and you can contact them, and they have a variety of packages that they can tell you. But the easiest way to actually do this peer group thing is to simply contact your Equilab rep. As I mentioned, this is something that we're simulating for people right now. We're trying to help them look at this ahead of time, and that'll be probably the best way you can do it. I'll also note, this is kind of the end of the regularly scheduled. I have some questions that I'll be taking, so if you have additional questions you'd love for me to answer, feel free to submit them. We're also going to be, if you have any questions and you have to step off now, feel free to send me an email. And also kind of put in the plug, we're going to be continuing this webinar series talking about pay for performance. And the next one will be on February 8th, where we'll be talking about anticipating and addressing potential negative recommendations. We'll be kind of delving into what are companies doing when they have a negative recommendation, what's some best practices for what they can be doing. So as I said, I'll just start jumping into some additional questions. So one is, what happens if we can't get to 14 companies despite relaxing the revenue criteria? And in the question, they actually made reference to what's called a super mega, and I'll mention that real specifically. So ISS has created this group they call super megas. There's a specific financial criteria in terms of market cap as well as revenue that they use to identify these companies. And a great example would be someone like Exxon, who is significantly larger than pretty much every other company in the whole world. So how do you find a good peer group? So those guys will all be compared to each other. If you're not a super mega, but you can't get to 14 companies, what is likely going to happen is that ISS is going to identify as many companies as they can get, whether it's 12 or 10 or 5, and then supplement additional companies into that, picking by hand. And we know that anecdotally that this has happened in the past. In previous iterations of their peer group, it also would be failing in certain places off kind of the numeric and mathematical selection process that they have. So what will likely happen is I would be looking back to see, after you run the simulation, were there any companies that you got compared to last year that you didn't include? Is there a really strong company in your peer group that just doesn't happen to have the same GICS code? And you can run some modeling off of that, because those are the, it's going to be hand selected, so it'll be a little bit more trickier to select. But at the same time, you can get a quick sense for it. I'll say the next one is, someone's handing me a question here. one question that's coming in is how are changes in CEO over the 5-year period handled? And what ISS has stated about the 5-year period is they'll be running that test if you have if only 1 year is missing. So if you have 4 years, the test will still be run because the weighting for that year will actually be changed to 0 as opposed to the number that we displayed on the screen, which will kind of exclude it from the calculation. If you have less than 3 years of data, or sorry, less than 4 years of data, the 5-year test won't be run for you. So that's one level. I think separately, if you've had changes in CEO, they're going to be looking at the CEO at the end of the fiscal year and trying to measure his compensation. So even if you had CEO changes over the course of the 5-year period, they are very likely to still run those same tests and see how you would score, kind of changing their philosophy from what has appeared to be in the past of we're trying to evaluate your current CEO as the CEO position to we're trying to evaluate how the board has been compensating CEOs. And I think that this also leads to interesting situations where if the board has previously decided to change CEOs, a lot of the equity that have been granted previously to those CEOs might have been canceled or been basically removed and be off the books. Yet the compensation itself will still be valued at target. So even though that is unearned and it can't possibly be paid out, it'll still appear in your scores. The second I'll note is where do the weightings come from? The simple answer for where those weightings come from is from ISS. The more complicated answer is they've applied a geometric average to those numbers to calculate how you would get them. Basically, if you run the geometric average of those 5 numbers, you will get 1. So basically, it's just a change in weighting. But it's designed to weight basically more recent decisions over older decisions. And if you noticed in the slide, if I go back, that there's actually, the weighting is about 1.5 in the most recent year, but only 0.66, 0.78 in the previous years. So it's almost like it's weighting it much, much, much heavier. Another question came in, I think this is also a good question, is how is mixed-year data handled? So if peers have not filed yet for 2011, how can I look at this? And part of that is you're going to want to stay on top of your peer group and start looking at this ahead of time. But I think at the same time, what's going to happen for ISS is it's really based not necessarily on when you file, or at least this is what we've heard about historically. It's really based on your annual meeting. So even if you happen to be the first company to file, if all of your other all your peers that they would have selected will have filed by your annual meeting or maybe about a month earlier than your annual meeting, all of that 2011 data will be probably likely included. If you have an annual meeting where none of those companies will have filed, I would definitely think that they're going to include some 2010 data. I would also guess that there's going to be, if somebody hasn't filed in a long time, like 2009, those companies will probably be excluded. I think there was a confirmation question someone's looking for. So as I mentioned, all of the simulations that I talked about here, Equilar has tools that can help you both build the GICS peer group and run a lot of these tests, which, as I mentioned, building that GICS peer group as well as that compensation information is really the difficult part. It's not running the test. It's going to be available in about, like I mentioned, in about a week. That is definitely the guidance. And if you have additional questions about exact timing or how much the product costs, I definitely suggest talking to your AM or Equilar rep, and because they'll have a lot more information about kind of your specific situation. I've got a Canadian client also out there asking about if they have any guidance on Canadian companies. And one of the ISS is, in one of their webinars had one of their heads of research from the Canadian side come on and mention it, and they just said that based on some feedback, they were going to delay rolling out all of these tests to the Canadian firms. And I think that a lot of these changes will probably come towards Canada in next year. And I would expect ISS to add additional guidance for how things might be if you're going to use. Will you include any U.S. peers as with Canada only? If it's using U.S. companies, how would you deal with exchange rates? And I expect that as they expand out over the next few months. So I think there's a lot more questions, but I think what I've taken up, I think, a little bit too much time. I apologize for running over today. As I mentioned, I got my email address on the screen here. If you have any questions whatsoever, I'd be more than happy to help talk to you about them, about how to stimulate these scores, as well as give you a reminder that we'll be talking more on February 8th for a webinar on anticipating and addressing potential negative recommendations. I hope this was helpful, and I wish everyone a great day. Thank you very much.